Hello and welcome everybody. I'm Stephen and I'm a popular investor on the eToro platform. Thanks very much for tuning into my video today, and please don't forget, please remember to like this video and subscribe to my channel. That will really help me out. Thank you very much. So in today's video, I'm going to be talking about what happened in the markets last week, as usual. And I'm also going to be talking about how our portfolio fared overall and some of the strategies that I deployed within our portfolio last week. So as we start off with the portfolio performance, last week, our portfolio finished about even, and I'm quite happy with the result of how we performed last week. And the reason why I'm quite happy with how the portfolio performed was the fact that the markets again last week were extremely volatile. And there was a lot of pressure because there was data that was released from the US in terms of inflation numbers, which I will talk about a bit more in detail. And there was also a lot of hostility between Russia and Ukraine and the threat of invasion of Ukraine by the Russians. So this really put pressure on the markets overall. And the Nasdaq was down about 2.2% and the S&P was down about 1.8%. So to finish flat was a really good result considering what happened. And the reason why I managed to keep our results flat was that I deployed quite a few hedges in the market. I shorted some indices such as the Russell 2000, also the Nasdaq. I also have a lot of European stocks in our portfolio, which helps us diversify. And they performed quite well last week. China also performed quite well as well as crypto. Some cryptos had decent performance, such as Bitcoin. So I managed to come off relatively unscathed in what was a very difficult week for the market overall. I know it can be unnerving sometimes, especially when you hear newspaper reports and sensationalist headlines about what's happening in Ukraine and Russia, for example, and also what may happen with interest rates rising. However, you need to take a really kind of long-term patient approach and know that interest rates rising it doesn't mean that stocks are going to go down, for example, for long periods of time. And actually stocks have performed pretty well in environments where interest rates have increased. Like, we must know that interest rates are basically at zero at the moment, and it's very natural in a stock market cycle for interest rates to be increased. And it'll be interesting to see what happens in the emergency meeting that has been called on Monday, in which I think they will talk a bit more about how those interest rates are going to be implemented and when the hikes are going to start. So don't particularly worry too much about this. It's something that happens in the markets from time to time. And as long as we are prepared for it and our portfolio stays agile, then we can counter it as best as we can. As we move on to the global weekly market update, and I will start off with the US. And the US was last week dominated by two pieces of news. And one of them was to do with the Russia-Ukraine conflict. And actually towards the end of the week, we saw the markets steeply drop. And that was because the US said that Russia was imminently going to invade Ukraine, and they had actually withdrawn their diplomats from the embassy in Ukraine. And this caused a big drop in the market. And what could this mean overall for the market? Well, one key point, I think, is that oil prices are likely to continue to go up. And I expect the oil stocks to do particularly well in this environment. And we are quite well set up with oil stocks within our portfolio to take advantage of this in terms of market. The other key point that happened in the markets last week was the inflation data that was actually released from the US. And the inflation data was at about 7.5% CPI. And what this meant was this was the highest level since 1982, and even higher than the reading that we had previously in December. And actually that was compared with a consensus estimate of about 7.3. So it did surprise to the upside, which did cause some fears around interest rates being increased much quicker. And this was further compounded on Friday by the Federal Reserve, who've actually called an emergency meeting for today on Monday to talk about potential action. So we don't know exactly what's going to happen in that meeting yet, but it could be likely that they either move forward when they're going to increase the interest rates, or they could potentially do a bigger than 0.25 increment, maybe to 0.5% increment in terms of a rate hike. But we will see what happens. But I'm not particularly too worried about it. I think that the threat of interest rates is mainly priced in, unless they do anything that is extremely, is an extreme, which I don't expect to do, because they have a dual mandate. One, to obviously control inflation, but they also want to make sure that the markets are buoyant. So we are not super exposed to it, because we don't have as many tech stocks as we previously had in our portfolio, which was intentional. And I think that our bank stocks, our insurance company stocks, should really benefit from increased interest rates. So we will see what happens there. Although there is a lot of fear of inflation at the moment, the overall earnings reports have been generally good, especially for the large companies. And there was actually a survey which I read this week, which actually said that out of all the companies that have reported over the last few weeks, 75% of them had mentioned inflation within the earnings calls. However, what we have seen is that the net margins have only decreased slightly. So this is a good sign in terms of stocks, because it shows that the companies are able to pass on those costs to the consumers. So they're not having a massive effect on the bottom line. However, it's important to note that this cannot go on forever, because there is certain type of price elasticity in terms of different sectors, and there's only a certain amount that you can actually put the prices up in certain scenarios. So we will see how that plays out. Reopening stocks also did quite well last week, and that is mainly because of the fears around Omicron are subsiding quite a lot. And this is because the cases are not generally that serious, although there is still quite a high case rate. It's not leading to a lot of hospitalizations or deaths. So this has caused a lot of governments around the world to stop the restrictions that they previously had in place, which has been very good for reopening stocks such as restaurants, casinos, and other type stocks. Also, in terms of Omicron, we also saw in the US states such as New York and Los Angeles have actually dropped the mask mandates. And we saw big companies such as Amazon, which have said that workers no longer have to wear masks within the warehouses. So this is another big sign that the restrictions in terms of COVID-19 and Omicron are starting to fade. As we move on to Europe now, and last week the shares in Europe generally rallied, which was a good sign for our portfolio and for Europe overall. And the reason why they rallied was last week the president of the ECB, Christine Lagarde, actually stated that the Eurozone was pushing back on increasing those interest rates fast. And they said that if they did increase those interest rates too quickly, then it could undermine the recovery of the Eurozone after COVID-19. So this really helped the shares in Europe to rally because it was quite a dovish stance overall from the ECB. However, on the flip side of that, the European Council actually revised the estimates for growth to 4%. And that was from the previous number of 4.5%. 4%. And this is probably another key reason why they do not want to raise their interest rates too fast in Europe, because they feel like the economy hasn't completely recovered from COVID-19, especially as Omicron has had quite a large effect on the economy over the last couple of months. Another piece of news is Emmanuel Macron, the president of France, has announced that France plans to add 6 new nuclear reactors over the coming decades. And we are seeing more and more of a positive stance over nuclear energy as a whole recently. So this is quite good for our portfolio because we have Euro, which is a uranium ETF, and I expect uranium to do really well for the rest of the year. As we move on to China now, and last week the Chinese stock market was generally very good. And a lot of the reason for this was that many people are expecting that the Chinese regulatory crackdown had started to fade. And the reason for this was there was an editorial article last week in the Chinese newspapers which said that technology regulations were going to be more rule-based in the future. And this really indicates that the majority of the regulations have been outlined already, and now they're ready to be implemented, which will be very good for the very undervalued tech sector in China. There was also some news from the property sector in which the Chinese government have announced that affordable housing, which had been kind of the key mantra to have this common prosperity theme around the country, was not going to be counted towards the cap of the amount of money that banks are allowed to lend to people, because they had put these regulations in place before because a lot of speculators were borrowing a lot of money without collateral. So that is really kind of good for the Chinese economy as a whole. China Evergrande Group, which is one of the largest property development companies in China, and we all know that they have been in a lot of trouble recently in terms of the money that they owe, have announced that they do not plan to sell off any more strategic assets, and instead they plan to reduce their debt by completing many of the projects that they currently have underway. And they've actually vowed to complete up to 50% of the pre-sold homes that they've already sold. We'll see what happens with that. They could be forced later down the line to sell key strategic assets. A lot will be seen as well in terms of the property prices in China. If they continue to slump, this may also be really negative overall for the property development companies within China. We're also seeing new financing and loans actually increase to all-time high levels in China. And this is seen as quite a good sign because it shows that there's going to be a lot of development and investment over the next few months and this year in China. And this is really on the back of a much looser monetary policy this year from China. And China is generally easing, whereas the other parts of the world are tightening. So I think this could be a very good tailwind overall for the economy in China. And I'm actually expecting Chinese stocks to actually outperform US stocks this year. There was also some data from China which said that the PMI had decreased to 51.2, and this is down from 53.1 in the previous month. So we are seeing some declines in terms of the manufacturing and service sector in China. As we move on to our top 3 performing stocks of last week, and in number 1, which is 𝗳𝗏, which is a Chinese hot pot restaurant, was actually up about 10.9%. And again, a lot of the reason for this was to do with Omicron fears subsiding. Obviously, as a restaurant chain, you want as many people to visit your restaurants as possible. So a subsiding Omicron is quite good overall for the stock. The second best performing stock in our portfolio last week was Micron Technologies, and that was up about 10.6%. The third best performing stock in our portfolio last week was Winmacao, and that was up by 7.8%. As we move on to crypto now, and last week the crypto markets were very up and down. Bitcoin finished the week slightly up at about 2%, but other altcoins such as Ethereum finished slightly down for the week. And at the beginning of the week, we actually saw some good rallies overall in crypto prices. However, towards the end of the week, we actually got swept up in terms of what was happening overall in the stock market, in terms of the Russia-Ukraine conflict, as well as, again, those threats over increased interest rates. And then we saw a dip towards the end of the week. We also saw last night, we saw many large companies who are involved in the crypto ecosystem actually advertise on the Super Bowl, which is one of the most talked about events around the US, as they try to bring in more and more consumers to make crypto much more mainstream. So we may see the effects of that over the next couple of months. The other piece of news was that the head of research at Fidelity actually stated that he expected Bitcoin to have a lot of upside from where we are now. And it's really good that these really large institutions are really starting to adopt cryptocurrency overall as a whole. And we also saw that BlackRock were planning to provide crypto services overall for its customers and were opening up a crypto desk. As you know, we have seen a big rise in NFTs over the last year or so. And one of the biggest beneficiaries of this has been OpenSea, which is the largest NFT platform in the world. And what they plan to do is they are opening up a venture fund in which they're going to invest over $200 million in new projects in the future. So this really just adds overall to the ecosystem. Binance also announced last week that they are going to be investing over $200 million in Forbes, which really shows that Binance are continuing to increase their reach, not only in traditional sectors, but also overall in crypto. And Binance is going from strength to strength, and CZ, who's the CEO of Binance, is fast becoming one of the richest people in the world. Lastly, if we look at on-chain data, we are also seeing a large amount of stable coins which are being moved over to exchanges. And this is generally a sign that people are waiting on the sidelines, ready to buy any dips that we might have. And I think that this looks really good overall for the future of crypto. And I'm expecting it to still do very well over the next couple of months. And we are very safely staying above that $40,000 mark at the moment. However, it's going to take a new drive of buying pressure to get it above those levels, but I'm confident over the next couple of months. Thank you very much for listening to my video today, and I thank you all for your patience and for your support over the last couple of months. Please also remember, if you haven't already, to join my Discord group. We have an amazing community of buzzing bees who are constantly talking about great investment subjects and asking me questions. So please see the link in the comments below in order to join that group. Have a good week ahead and happy trading.